That's the way we're going to do our chats, and we'll be in good shape. And we're going to get started in 2 minutes. A very exciting market rally. Everything's up and up and up. Let's see, 16,882 on the Dow. That's up 90 points a day. Another rocking day. Can't even mind. Everybody's up half a point. Core oil, on the other hand, is at 95.22. That's not good. Wait, oh, that's the old oil. Silly me. The new oil is just as bad. It's 93.09. I actually went long on that. So I'm down. Fantastic. Thanks, Mark. All right, we're going to get started in just a minute. People coming in. That's nice. Oh, I probably should start recording this. How do I make sure I'm recording? I don't know. That's odd. Recording. Event. Recording settings. Record audio. Well, it says it's record audio. Oh, I see. Here's my little recording button. Okay, all seems to be working correctly then. All right, officially we are going to get started. So let's see, I'm going to share my screen. So hang on a second, you should be able to see my desktop in a moment. Oh, there is one more bug. Greg still has to fix its disclosure document. Hopefully we'll get that working correctly. Chat, fantastic. Okay. There it is. Disclosure. Great. Okay, here we go. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed, attract, monitored, and virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involve risks. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and trading services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on the mailing list and receive our newsletter. Rest assured, we take your privacy very seriously. We will not distribute or sell information to anyone. Fantastic. All right, hopefully everybody can see my screen, and now we can see what's going on in the markets. Woohoo, look at that. All right. These are some stunning little charts, aren't they? Very impressive. Everything is up, 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 and more up, and we can go to the bigger charts, and I'm sure we'll see everything is up and up and up, too. Poor silver's not up yet. Where are we? All right. Oh, remember we wanted to short the Nikkei at 15.5. I still like that line for shorting NKD. But you know, you're not getting any kind of confirmation of anything else going down, but I like that line. That's a nice, good shorting line for the Nikkei. The dollar is, look at that, all the way up to 82. So the dollar's been crushing it, and the market's been going up. That's not usual, all right? The reason I like going long on oil is because it's being pushed down by the dollar. And so is gold. Gold's back to 1296, and so is silver at 1943. So I like silver long here up this 1940 line. I like it up 1952. Wait for it to cross to be more short. But this 1940 line, as you can see, at 1936, we have this support, and it already tested that and popped back up. That is a really big move on the dollar. From yesterday, 81.40 to 81.90 now. So half a point is, you know, more than 0.5% because you're only off of 80. So you're about 0.7% downward pressure. So gold hasn't fallen 0.7%. The downward pressure is only stopping it from going higher, but we're still holding these lows. Gold wants to go up, the dollar's not letting it. Silver wants to go up, the dollar's not letting it. Now, the Nikkei loves a strong dollar. So in several ways here, we'd be playing the dollar to be rejected at 82. We're playing, so we expect that the Nikkei will fall when the dollar is rejected from 82. We believe that gold will go up, so 1295 is a good place to be long on gold. Silver will go up, 1943. I'll take 1940, 1945. I'll take any of those lines, but I think we'll be back up to 1950, no problem. And gasoline's been going up regardless. Natural gas, I wouldn't play that. Here's gasoline again for some reason. And here's the, oh, this is a new oil contract. It's currently at 93.16. Now, I went long at 93.25, so I got a problem because I'm already down a bit on this one. And the low is 93.05. So I'm not too pleased with that turn. But that's not what we're going to talk about today. What's this? We don't want that. Okay. Okay, any questions before I get started? We're going to cover a few topics today and we'll see what happens. All right. Well, I know what I want to look at. All right. If you are not a Phil Stockwell member, you must not look at this list. It's a buy list for members only. Only members should look at it. Let's see. So in our virtual portfolios tab, we have June. I'm a little behind. The June trade review. Good luck. I think I'm going to skip July at this point. It's May trade review. Got to June, but that I kind of just haven't been too busy. These are really tedious to put together, by the way. I mean, I have to look up every single trade and figure out how much they did and how much they changed since the time we traded and so on. So it's killer. It's like I have to have like 5-6 hours extra on a weekend to do those things. All right, so that's per week, not per month. So it's like another week's worth of work by the time I finish them off. So where are we? The buy list, right? There are actually 29 trades by the time we got done with it. We compiled our buy list over the course of about a month during the month of May and a little bit into June, I think. And during this month, where are we? Here we go. SPX. So what happened is we sort of reset our portfolio on the long-term portfolio as the market was coming around here. Whoa, son of a bitch. Die. Oh, why doesn't my pop-up marker stop that? All right. So where were we? Oh, yeah. So we went to cash over here, but we went to cash with the idea that we were going to cash out our winners. We have plenty of winners because we've been long all year long. We've been long since November, and here we did a lot of buying. When the market dipped here in February, we did a lot of buying on the long-term portfolio. We cashed out our winners here, and this is back to that fresh horses concept. and we loaded up on the fresh horses. We went and found a whole another bunch of stocks that we liked as long-term plays. So we were heavy into buying during the month of May and picking things up, and that's how we started compiling the buy list. We found a lot more stocks than we actually took officially, but you can see, and I like this one. I love these charts from who's all they? Finviz, F-I-N-V-I-Z, because they're dynamic. So every time I look at them, they update themselves. So even though we actually made this, what's the date? On June 7th, we made this list. That was the final date of when these things were added on June 7th. But since June 7th, they've still been updating themselves, which is very nice. Saves me a lot of work anyway. All right. So where are we? I talked about a couple of them in the morning post, and we have a few that have taken off on us, obviously. So we'll look at the ones that did. We got ADX gone already, obviously, from June to here. These guys also, ACAN took off. Broadcom took off. CCJ, not yet, though. So here's one we actually still like. We have the CCJ play. CIM, I mean, we always like CIM. If they ever get cheap, we like them more. But it really matters on whether they can make a good cross where you can sell puts and calls. If you can sell good calls, you can always sell puts. If you can sell a call at the strike, that's where you want to get into them. So they're strikes at every dime. So this is not a good spot to sell. And unfortunately, if you only sell a 10-cent call or a 15-cent call, so you're never going to get a good price. But it's a fantastic little real estate trust. It's just, and they pay a 10% dividend. So well worth earning for the long term, even if you only get your tiny little discounts. CLF, I love. Same thing, X just started taking off, US Steel. And CLF, they produce iron ore pellets. And iron ore pellets are, if the economy is recovering, this is something people need. And you can say, oh, they get undersold in China or nonsense like that. That's always a knock on them, that China produces it cheaper, but they don't care. They're selling to America. If the demand's in America, you got to realize that it's a lot cheaper for them to stick a load of iron ore pellets on a train and ship it to you than it is for you to contact someone in China. Even if they make the iron ore pellets for half the price, by the time it gets here on a boat and a train, it basically is back to the same price that CLF is selling for. So they have a good little business, but we have the terrible economy. That's the only reason they're down. But as a long-term investment, this is absolutely the kind of stock you want to own. And they have fantastic option prices, always good puts to sell because nobody believes in these guys. eBay was a gift, on 520. At around here, they got low enough where we got excited about them. They even went lower, and now they're coming back. But I always like eBay when they're cheap. They're a good company. PayPal. That's why eBay. I mean, it's not just eBay. You're getting like a credit card company for free when you go to eBay. Ed is a nice, safe little utility company, and we picked up on the 55 line here. And now they're up. They're going to go up. They're going to go down. It's a channel. You're buying these guys for dividend. FCX again. This is a huge copper company, and copper's coming back, and they're coming back. That's a brainless call. It's so easy to do. Harmony is a small gold miner. Our favorite is ADX, of course, but we also do like Harmony, and they were on sale, 6.3. See, it's not, I don't always jump on these things, but when they would, they went down here, and this is what fundamental investing is about. I mean, you got to look at it and say, well, they're bad. They had a bad report, but it wasn't that bad. So we got a great deal on them down here. Hovnadian is just coming back. You guys know I'm always banging the table on Hovnadian. They're a big play in our long-term portfolio. We like those guys. IBM is IBM. I don't forget to sell IBM to you. When they get cheap, we buy them. End of story. IGT, they got bought. They're gone. So that's too bad because I love them. iRobot. Anytime iRobot's cheap, we want them. They're a stock of the century. So, 100 years from now, I'll still be telling you I want to buy the iRobot, unless it's up in the thousands, and I'll probably get tired of it. I seriously do believe iRobot will one day trade. If it's $35 now, one day iRobot will be a $300 stock. Okay, they will they will come up with a line that the military bites on, give them $1 billion contract, and the company will double and triple overnight. Let's see. I mean, they're prototyping everything. That's what they do. They're basically an R&D company. They're constantly figuring out new robots and new things. And it doesn't make much money if they haven't come up with a mass production robot that's wanted yet, but they will. Ed for butterfly. No, it's not a good butterfly because they don't have very good option pricing, unfortunately, because they're so. See, the best butterflies are the ones that are kind of they've just gone through a rough period, and then you expect them to calm down. Those are the best butterflies because the option prices are inflated in the short term versus what you expect them to stay at over the long term. Don't forget, we're selling those short-term options. You know, so it depends. Now, of course, we do have. Well, we don't do it in the butterfly portfolio, but we have fast money, which is what we call the butterfly that we use. It's the FAS. That one is a violent one that we like to play also, but we do that in the short-term portfolio because you can get really blown out by things like that. They're fun, but, you know, it's not the idea of the butterfly portfolio. The idea of the butterfly portfolio is that you don't have to worry about things. That's why we dumped Caesar out of it because it's too much of a pain in the ass. JDSU still cheap. Okay, we got them on 520. They were lower. They were cheaper then. They're up a little bit now, but not much. They had a nice run. Then they failed. Now they're back up. But you know what? When we're buying these things for long term, we don't give a crap. We sold the 2016 $10 puts for $1.55. All we care about is we stay over 10. That's our game plan for the next 18 months. KBH, we just had good home builder news today, so they're popping too. We like those guys. Newmont Mining, yet another gold miner. It's you know, the premise of gold being more expensive 18 months from now, I didn't think was very complicated. So we're just looking for gold mines. The other gold mine we like is NAK. I don't even know what they're doing right now. They're the most hated one. They're like a penny stock, but we like them because it's fun. I mean, they might jump up. They're at 70 cents now. They might, if they ever get, if they're ever allowed, if they clear the environmental hurdles, which is substantial, but if they ever clear their environmental hurdles, this stock will fly. So it's just kind of a fun thing to own. But certainly not, it's not something that would merit being on the buy list, which are stocks that we, you know, strongly believe in as long-term investments. NLY, another REIT that we love, the same guys who run CIM, same management team runs Chimera. So we like them, we like the main company like Chimera. They're both, and the dividends on this are fantastic. You have a much easier time entering NLY than you do CIM because they've got better option prices. Zhao says, if you load up on these in May, would you do a second scale or would you wait till much interest rate touch? Wait, that's what we're doing. So I guess the answer is wait because that's what we are doing in the long-term portfolio. We're only 30% invested, but despite being only 30% invested, we're up like 20%. So, you know, I don't want to. Why would I want to risk it? There are certain stocks that are buys, ones that go down, and that's the point of it. That's the point of this thing. The reason I love these dynamic charts is you can look at this any day and say, I feel like adding a stock. And you say, oh, look, Pfizer's low. I mean, you know, so it's on our long-term portfolio. Obviously, you should ask me in chat, but our opinion hasn't changed on Pfizer. We still love them long-term. We still pay a huge dividend. It's a good, solid company to own for long-term. They'll go up and they'll go down, but over time, because, you know, using our standard strategy to keep lowering the cost basis over time, why wouldn't you want to get into a stock like Pfizer? That's the ideal stock for our primary strategy, which is to grind down your cost basis over time and then just collect your premiums and just sell some calls on the stock over, you know, 20 years from now. That's the point. NTAP, they took off, so they're gone. So as far as they're concerned, we wouldn't get back in that. Penworth, nice little energy play. They had a lovely little bottom here. Where were they when we liked them? 6.3. Yeah, so they were right where they are now when we started with them. You know, and again, it goes back to, see, this is when you're loading up. When you take that initial position and then they plunge to 52, which is only about a 10% drop. No, not even. So they, you know, they fell 5% and held that line. that would be a time to double down when you have that exciting premium that you're getting over here, if you're going to start adding to your position. And you know, you want to take advantage. You have to learn what to do. So in other words, what would I do here? As soon as when I see a move like this, and especially because think about what you would have been doing. You say you got this on 6-3 when we started, right? It dropped a little bit, then it flew back up. So barely touched down here, flew back up. So now you think, damn, I wish I bought more. So when it comes back here, when this happens, you got to say to yourself, oh, now's the time I want to buy more. It did the same drop last time, and I was so mad I missed it last time that I should go here. It's, you know, you got to learn the behavior of the stocks that you're in, and that's, you know, so a lot of times those initial entries we make are like getting to know you kind of entry, and that goes for Rig too. In fact, so Rig the next one. Look at Rig; they just had a wonderful little drop, fantastic time to increase your position, and we did. We added to our position that we had in one of the portfolios. Let's see, Rig was 520, so 520 they were here, which is about 41 bucks, let's say. It fell down to 38, but so what? I don't care, because what was our position on Rig? We took the, we want to sell the 35 put. So my call for Rig is that they're not going to go below 35, and we're netting into 31.45. What do I care if it drops to 38? But that was a great time to buy this. If you had just gone with the puts, it's a great time to add the 40-50 bull call spread. All right, and see, and at the time, which was 520, so let's see, 520 is around here. This is when we like them. And I said, if they go over 43, it might be a good time to jump in. They didn't. See how they popped this? See how I was right about that 43 line? They popped it, but then they held it, but then they failed it. So they had a bad earnings report here. And they went back down. But I still like them, and I still think that this is, you know, getting up to 43 is going to be the right price for these guys. So fantastic one to get into now. RRD, I never understand how these guys pay a huge dividend. For some reason, people don't like them. They fall in and out of favor. And I don't get that. I always like them. So they were cheap. 513 was, again, it's, you know, and I don't want to say the same thing all the time. Oh, you missed a drop in August. It's okay, but you missed a drop and there's something else. Every week there's something. Like right now, look. Right now, here's Rig. You know, the idea of having a buy list is that we've got 29 stocks here, and at any given time, one of them goes on sale. We like them for fundamental reasons. This goes back to, and I hate to keep repeating it, but it's like that Levi example I keep telling you about. It's like a stock is like a pair of jeans. I know I want them. You know, there are some stocks that I know for sure that I want them if they're cheap. So just like a pair of jeans, I have 5 jeans in my closet, maybe one of them and 2 of them are in bad shape, that I should probably get a new one. But I'm not in a hurry. I have 3 good pair. I have 2 crappy pair. I have 2 pair I wear, 1 pair for sports. I have a pair I wear for painting and stuff like that. So I got 5 pair of jeans. I would like another pair, but I sure don't need another pair. But I also know that a pair of jeans cost me 40, but you know, a normal price is 40 bucks. Or I'm sorry, the normal sale price is 40 bucks. So if I see them for 50 bucks in the mall, I'm not interested. If I see them for 40 bucks, I'm kind of interested. If I see them for $30, I'm more interested, not less interested. And this is the problem that you guys have as stock buyers, okay? Because if you don't have a firm price in mind that your stock is worth, how do you make a decision? Right? So Rig, like a pair of Levi's, is worth 35 bucks to me at least. So when it gets to a point where I can create an options for it or something that gets me in the stock for 35 or less, I'm interested. I know I'm interested. I don't care if other people are not interested. I don't care if the stock gets oversold. I only care about my price at my part. Right? In other words, if you're in a, you know, again, if you're in the store and your pair of Levi jeans are 30 bucks because they're having some kind of blowout sale, all right, do you stand at the store and when you're about to pick up your jeans, the person next to you picks up the jeans and puts them down and goes, oh, I don't want to buy it. Does that make you not buy it? No, because you know that you want them, right? You're not influenced by some person who picks them up and looks at them. Even though the exact same jeans you want, you don't care that somebody else doesn't like it. And you sure as hell don't sit there and look at reviews. You don't endlessly look at reviews and obsess over what every single person in America says about your jeans, do you? You wouldn't even think about doing that. When's the last time you read a review of the clothes you wear? Well, if you're a guy, for sure. I don't know about girls. If you're a guy, I mean, who the hell cares what somebody else thinks? And why can't you be that way about a stock then? All right? Now, if you take it to another level, let's say a car, because a car is a bigger purchase decision for you, you might kind of want to read the reviews, but you mostly want to read a review on a car you like to say, does it suck or not? You're not reading a review to say, I'm going to buy the best car in America, and therefore I'm going to only read the review. You have your own considerations. You know what you like in a car, and you know what you're willing to pay. So you have an idea in mind. You say, I'm going to either buy, maybe you'll say, I'm going to either buy the Toyota, or I'm going to buy the Camry, or I'm going to buy the Buick something or other. God knows what Buick makes. But I buy a Buick something, I buy the Toyota, and I'll go take a look at the Mazda just to see what they have. And you know, so between three things of comparable value, you're going to pick the one you think is the best value. Right? So, but that's, you don't, but after that, you don't care. You're not sitting there, you don't go to all your neighbors and ask them what they think, and you don't call your mechanic and ask him what he thinks. You're picking it for you because you like it, and you have a fairly good understanding of the worth of the thing that you're buying. All right? Why not stocks, though? Why do you treat stocks like they're some kind of mystical thing that you can't possibly fathom? Therefore, you're going to defer your entire knowledge to other people, you know, including me, frankly. I mean, it's like, you know, I'm helpful and I'm good at filtering some stuff, but you still got to make a decision based on what you know and understand. Otherwise, you're always going to be at everybody else's mercy. I'm just trying to give you guys ideas, and I'm trying to show you how these things work. But, you know, it's not up to me to tell you to buy a stock, just like I wouldn't tell you what jeans to buy. You got to pick something that you're comfortable with, and then you can work on it. Not just flip from thing to thing, and don't go by what the last guy you read said, or what any 20 people say on Yahoo or Seeking Out or anything like that. You know, it's like find things you know and understand and trade them, because if you stick with those things, you'll get comfortable with them and you'll get better at trading them. All right, so that's my little lecture for the morning. Wayne says, oh, this is great, we can all chat now. If you are open to a new position on FISA or RIG, would you walk through the thinking of what strikes you? Yes, that's a very, very good idea. Brilliant. All right, RIG. Now, I firmly believe RIG is worth more than $35, okay? And let's take a quick look. I don't want to get too long on this topic, but we'll take a quick look at Yahoo Finance. We shall put in RIG, R-I-G. And there they are. Lovely. We will look at what the latest news is. Oh, and you guys all have to thank me, okay, because my badgering has finally gotten Seeking Alpha and Motley Fool removed from the headlines of Yahoo.com, and they are now pretty much only serious news organizations are on here. So when you look at the news, it's actually helpful instead of just whatever pump and dump crap is on there. I've been lobbying for this for years. Very, very pleased with it. So we look at the latest news now instead of just the latest rumors, and we find out that nothing is really happening. Barron's is up and down on them. It's a weak rig market pricey, and I have to read that article. I know what they're talking about. At least it's not getting worse. I love that. All right, they had better day rates. And what do we know, though? Here's the biggest thing that I know about rig is that we're in a boom of drilling in America. There's a lot of oil drilling. There's a lot of new exploration. They just discovered oil in Australia. They just discovered they're drilling the Antarctic now. Where are all these rigs going to come from? Even if they don't buy it from Transocean directly, they're buying it from somebody who competes with Transocean, and that sucks up the rig capacity. You know, worldwide, there's only X amount of rigs. They take a long time to build. Big son-of-a-bitch things. They're huge projects. So there's a demand. Same thing with the shipbuilders now. The shippers are all suddenly doing well because the Baltic Dry Index, oh, this is a big story, by the way. The Baltic Dry Index, remember Remember Eagle, who's the one I kept busting everybody? Every week I say, buy Eagle, buy Eagle, buy Eagle. Because this Baltic Dry Index, look at that. That's a nice little recovery. Gone from 700 to over 1,000. 33% in a month. Okay? It looks even more dramatic on the weekly chart. 33% in a month. All right? That's a nice little pop. We're probably going to get back to 1,200, and then we'll see what's happening at the 200-day moving average. But that is nice. All right? So we'll see what happens there. So rig, back to them. They have a current PE of 9. They have a forward PE of 11 or 12, but that's because bad day rates are priced in forward. If day rates aren't actually bad, they're fine. They pay a 6.6% dividend. All right, this is a good stock. Oh, and I'm sorry, and they just spun out some rigs also. This is a really nice deal that we were happy about. That's why the price went down, I think. They were spinning out 3 of their rigs. They spun out into a new company, which they still own. They own more than half of it. They raised capital. So, didn't we talk about this last week? They spin it out to the new company. The new company goes public, and or whatever they did. They raised capital. They raised $2 billion to pay for the rig. So the $2 billion then goes to rig and drops in as cash. So now they don't have to, now they're done. They've got cash in the books. They pay down their own debt or buy more rigs or whatever they plan on doing. But they spun out the new companies now paid for the rigs, and Transocean still gets half the profits from it. That's a freaking fantastic deal. It's like, please do more of those. And for some reason, people didn't like that, and they dropped the stock, which I thought was insane. So that's one of the reasons the Transocean stock did drop. Anyway, many reasons to like them. Even if the PE is going to 11 or 12, that's still fine. And again, down the road, there will be more drilling. There will be more oil. It's the way to go. Oh, and what are the something? Oh, I'm drawing a blank, but there's another kind of drilling that they're starting to do, and the other kind of drilling is going to use the same rig, but they have to retrofit them. So there's a lot of good reasons to like these guys. So what do we like about them? So while they're still low, we try to take advantage. Oh, you know what's killing oil right now is that they're dumping those old contracts, the old oil contracts from last month, from September, are the ones that are expiring tomorrow. They're down to 95. They just failed the $95 line into the close. You know, still an hour until the close. So that's really bad. So that's what's putting pressure. And that's putting pressure on the October contract, which is unfair because, you know, it's not their fault. It's not their fault that people have to dump the September contract. But you know, once that's done, the pressure should be off, and you'll see October sort of rise up a bit. But it's hard to say when they're actually going to turn. Sound like Uncle Warren? Well, thank you. Not too many people I idolize in this world, but he's one. Let's see, rig. Oh yeah, right. What do we do? I'm trying to figure out what do we do with rig. So they're at $40 now ish, and well, there is that 6% dividend. So there's a couple of ways you want to look at it. We've already got these short, the $40. Now, see, this, I had sold the $40 puts because I'm very, very confident that, you know, if you sell these to 732, you're going to net in for 42.70, or I'm sorry, 32.70, and I'm very, very comfortable with owning rig at 32.70. So that's an aggressive sale, that particular one. If you want to sell the puts and you don't want to be too aggressive, I mean, selling 35 puts for $4, that nets you in 30. I do like these better. I mean, you know, honestly, there's not much downside to collecting the extra $260 for selling these. You're only missing a few dollars, missing $5 of a position, but you're collecting $260 more. But it's a more aggressive bet. You're betting the rig is actually going to finish a little bit higher than it is now. I'm comfortable with that bet for the long term. That's blowing off the dividend. If you wanted to buy the stock, you can buy the stock for $40, sell the $38 calls here for $4, All right, so what do we got? $39.50, so that would bring us to $35.50 net. Then we'll try to raise another few bucks, so we'll raise another $4.50-ish doing these. So that brings us down to 35, wait, is that right? No. What do we say? 35.50 minus another 4.50 is 31. So this would net you down to 31 if you sold these puts as well. And then you'd be collecting that dividend. Right? So in other words, you buy Rick for $39.50. You sell the 38 calls for, well, it's not $3.50, but anyway, so for $3.26. All right, and you sell the $35 puts for $4.30. All right, so you're going to take off $3.26 from $4.30 is $7.60 something. All right, so let's say $7.60. All right, let's say $7.50 to make it easy. So we're going to take off $7.50. So you'll net in for $32. Your call away is $38, so that's about 20% plus call away. But the reason I like this is because while you're in the position, you're going to collect a $3 dividend. Oh. And you're going to collect that, probably, assumably, you're only going to collect next month. Well, let's see. And if you want to know on Yahoo, it is actually very useful to know this stuff. You go to dividends only under historical prices, and it shows you where these dividends came. And that's weird. Okay, so May, February. Oh, they're erratic. Wait a minute. They're not paying as much of a dividend as Yahoo's saying. That's a shame. But anyway, so I wouldn't do it. All right, so there you go. They don't actually pay as much dividend, I don't think. Let me see. May in 2013, they paid 50, 50, 50, 50. Oh, I see. Well, no, then they raised it to 75 in May, so there is another one coming, June, July, August. So you get 2 more dividends this year. All right, maybe they are going to pay it. So you get 2 dividends this year, and that's $1.50 if it holds. Then you'll get $3 next year. So that's $4.50. So you're buying into net 32. You get $4.50 in dividends. That's like 15% in dividends. And then if the stock holds 38, you're going to get called away for 38 with another $6, which is another 20% of what you paid. So you're going to get like 35% on the stock over the next 16 months. And all it has to do is hold $38. That's how I like to buy things. That's good. Okay, that's really good. That's the way you buy stuff. So you weigh that out versus, and then and the way you look at it, saying, well, okay, I like that. That's nice, obviously. But then you compare that to just selling the puts. And if I said, well, maybe I want to just sell the $40 puts for $7. And how much am I going to get? I'm going to get if I sell 10, I'd get $7,000 for doing that. Versus if I bought the stock and I made $6 on the sale of the stock plus another $4.50 dividends, $10.50. So if I tie up $32,000 now, I'm going to expect to make $10,500 over the course of the next 16 months. Whereas, oh, it does. Thank you. Okay. Gal says, in TOS, if I hit the blue arrow. Now, the question is, what the hell blue arrow is he talking about? This one? Oh, the company profile. You don't mean the company profile, do you? Underline. Oh, this thing? Oh, it does say 75, yeah, okay. I still don't trust them, though. I like to see what's actually happening. I much prefer Yahoo when it lays it out, because I can see what they've actually paid, and then you can decide whether it's erratic or not. All right, because watch, in Yahoo Finance, historical prices, dividends, right? It's, for whatever reason, they've got a lot of junk in the prices, but I like the fact that you can see when they pay and what they pay. So last year they paid 56, very steady. The year before they paid 79. So you get the impression that they they kind of adjust based on what they think they're going to be able to pay, but they seem to stick to whatever price they say they're going to do. So they went from 79 to 56, and now they've adjusted back to 75. This seems like junky data. I don't know why. All right. But the gist of it is they did go this year from 56 to 75. So we assume that they'll keep the 75. But I like to see that. I like to know, you know, that it's not erratic, that you know what's going on, that you can see how they're paying out. They used to pay like no dividend and change they used to pay 4 cents. They changed their mind and they've 84 to 16 stock split. I don't think that was wrong. But they, look at that, they paid a special dividend here, $33. You never missed that one, right? So anyway, so I like to see the history of what they've been doing. You know, it helps you decide whether or not they're reliable for the dividend. Thank you for telling me that flew out, though. I didn't even know what was there. Let me see. I'm sorry, where were we? We were in here. Yeah, so, okay, I'm sorry. So you can get $10,500 by doing 1,000 shares and selling 1,000 of the 38 calls and 1,000 of the 35 puts. All right? Now, instead, I'm saying I'm perfectly happy to collect $7,300 here by selling 10 of these suckers. And see, my margin is only $3,000. That's like super efficient. So, you know, as much as I love Transocean, and I'd be very, 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 very happy to own them. That's in fact why I'm going with it. I'm going with the aggressive put sale. I'm thrilled to own them to net 33 if the thing drops. I'm not worried about that. But it just is so much more efficient for me not to tie up $30,000 to collect $10,000 when I can tie up $3,000 or $3,400 to collect $7,500. All right. Either way, my downside is the same. I'm going to end up owning Transocean at about the same net at about $33. Either way. But in this particular case, I got $30,000 left to do other stuff with. So I'm going to make a lot more than $3,000 with $30,000. All right. So that's you know, something to consider. If you want to, you know, it helps you diversify. It's just to have the cash on the sideline. And then plus, even so, since I'm only committed to 1x here, and the other one, you're actually committed to 2x if they drop. You own the stock and you sell the puts. So since I only have a 1x commitment by just doing the put sale, if they do drop dramatically and I have a chance, I've got tons of cash on the sideline to get back into it. All right, so next in. Craig says, why would you sell 38 calls if you bought the stock for 39? I don't understand the strategy. I see it a lot. Well, yeah, but it won't get called away because the reality is it's not very often, unless your stock goes way high above the call, it's not that often that somebody's going to call, is going to exercise their call option. And why is that? Because even if they have 10 cents worth of premium in the call, they're not going to exercise it because they're just throwing 10 cents out the window. There's no harm to them in selling the call. You know, so since there's no net benefit, it's not worth it for them. Sorry about that. Shouldn't be wrong. Anyhow, where are we? So I like it. You know, the point is to lower your cost basis and provide you protection because we don't assume that we're right. You know, and again, this goes back to it. I can't stress this enough in our strategy. Is that we want to be protected when we're wrong. We want to be protected when the market crashes. So, you know, it's not about maximizing your profit because you don't maximize your profit unless you're right. If you're wrong, you're maximizing your losses. So we're taking a sort of middle-of-the-road thing and saying, you know, it's like, yeah, sure, we believe in the stock, but just in case, I'd like to have a little bit of protection to the downside. And when you get to that point, like here's, you know, all right, let's assume, like here we are in January, so it's July now, or August, or whatever. So it's August now. So if we had sold the 38 January calls, right, they're 270. All right, that's the 38s. The stock's at 39.50. This is effectively 40.70 or 40.65 with the last hit. So is anybody going to call this stock from us? Is anybody going to cancel their contract for $265 just so they can buy the stock for $38 and they'll pay a net, by doing that, they'll pay a net of 40.65? Or will they just buy the damn stock for $359 from someone else and sell their contract? So we're not going to get called away. All right, until you get to a really low number, we're not going to get called away. And so all we're going to do is, so at this point, let's say we are 3 months out of the contract expiring, or 4 months out of the contract expiring. What are we going to do? We're going to say, well, look, we sold these 38 calls, and we sold them for $4 2 years ago, or a year and a half ago. And now they're at $265. And what are we going to do? We're going to roll them to next year 38 and pick up $2 more. That's all. We're going to make a decision and we're going to roll the call, so that's going to now buy us more upside. So we're rolling our hedge higher. And again, these are I know this is always hard, because this is only the first step in a 10-step process over the next 20 years of owning this stock. So, you know, the stock can double over 10 years, and we're going to be able to roll right along with it every time. We're going to have higher and higher and higher calls. And at the same time, we'll also be rolling our put up a little bit and so on and so forth. But we'll just keep collecting more and more premium, and every time we do that, we drop our basis to a lower price. And at a certain point, if we finally do get called away, if the thing spikes up like crazy and we get called away, we're not complaining. We're going to say, thank you very much for the cash. Even if we get called away tomorrow, we're going to make 20%. So that's not a problem. What I care about is protecting my downside, though. I can manufacture good years. I can manufacture good years any time that the market is flat or up. It doesn't matter how much it's up. This position, as you can see, pays 20%, or not counting dividend, pays 35% in 16 months. Whether the market is flat or up, not the market, but whether rig is flat or up. But basically, so conceptually, if the market is flat or up, I have a high expectation of making 35%. I can manufacture that over and over and over again for every single year for the next 20 years. That's not my problem. What I want to avoid is losing 20%. All right, and again, if you go back to like compounding your money, making 20% 10 years in a row is going to give you, I think, 5 times your money. So I'd rather do that conservatively and lock in those gains than risk some large downside where I don't see, I don't mind having a 0 year, but I do mind losing one. I don't mind. So if we have 20% protection to the downside, the chance of having a losing year is very, very slim. We might have an even year, but that's not so bad. Because still, out of 20 years, I can pull 15 years. 15 years when the market doesn't drop 20%. So a flatter uptime, 15 years, I'm going to make 20%. In the down years, I might make 0 if the market drops 20%, but I'll have 0, 0, 0, but then 20, 20, 20 on the other years. So you're guaranteeing ourselves for 20. And I know sometimes, like last year, the market went up 30%. And you might go, oh, okay, I only make 30%. So what? I'd rather make 20% a lot than make 30% once in a while. And I'd rather not lose 20%, because the only way you would have made 30% with the market last year is if you're 100% bullish with no hedges. That's so you say, oh, I could have made what the S&P made. Yeah, if you were 100% bullish on the S&P with all of your money, you would have made 30%. We weren't. We were, we're not even half invested, and we're making 20% with our money at the sidelines, and so we missed out on 10% that could have, would have, should have. But I'd still rather be hedged over the long haul, because over the long haul, 2008 does happen. 2000 does happen. Markets do drop 30% on you. So if you're sitting there heavily invested, the market drops 30% on you, and you can't get out of it, you end up blowing 2 years' worth of gains. How do you get back from that? But if you're hedged 20% to the downside, and your worst case is probably 0, then you don't have anything to make up. You just had a year when you didn't make any money. But the next year, you're going to make 20% again. All right, so that's helpful. So that's rig. I think somebody asked about two stocks. That's rig. So I think it's a similar concept to the other one. I want to move on from these. Pfizer or rig. Yeah, Pfizer is the same thing. You can trust a similar play. All right. Craig asked that question. G. Basserman says, rig announced company shareholders 214 meeting dividend $3 per share. Out of paid-in capital, dividend payable, void sold. Okay, so they have authorized the whole $3. Great. Thank you. Appreciate that. All right. Next topic, I think. First of all, let's see how things are going. Same old, except oil is really pathetic. It's going to kill me. Damn it. I got to buy more. $1,400. Now, see, there's no real support here. You go all the way down to 1967. So I have 3 contracts. And my theory is this is being caused by people panicking out of the September contract. These are October contracts. I have a month for them to recover, and they're not recovering, so we'll see. But I'm certainly willing to add a few more. So let's see. Right now, I'm at 93.29. And this is way down 92.81. So this is a 50-cent spread. So if I add one more here, I'm going to drop these 3 by about 15 cents. That's good. I'll do that. So let's do that. We're going to add one more. There we go. And now we're down to like 93.15. Okay. So the next one I add, if I added 15 cents lower than this at 65, that's going to drop me right about to the 93 line. I can live with being at the 93 line. So then I'll go up one more contract. The 5 contracts is a lot for oil. We are really screwed on the downside. I mean, obviously $1,500 is already kind of screwed. Now, of course, anytime you're adding positions like this, you absolutely are looking to get out. So if we get back to 93, it doesn't have to be 93.17. You want to get back to 93, I'd want to lighten back up, at least take one off. So I'm keeping track of 2 things. I'm keeping track of my last entry, 92.80, and my next entry is 92.65. All right, but if I get up to 92.95, I'm still going to make, still going to make some money. I want to take out and lighten up a little bit. All right, so not worth staring at those. So basically, it's a very bullish market in what's happening with the dollar. Look at that, the dollar is so strong, it's pushing things up. And the Nikkei is just 15,490, just barely there. Look at Exxon, $100. That's completely ignoring oil. That's going to be a fun short again, actually. I think we should probably add that. See how our portfolio is doing. There's a good topic change. Let's see how our portfolio is doing. We'll decide what to add. Is USA good? USO is a long play now. No, I don't. I'm not too fond of USO as a long play. I don't really think oil could collapse. And we'll know more soon. If oil, see, here's the thing. If oil does collapse, then I'm going to like USO for a long play. In case it doesn't collapse, I'm currently playing the futures long. Because if it doesn't collapse, that'll be a soon thing. If it does collapse, then it'll be a long-term grind. I will make a heavy bet on USO if it gets down to like 85. It starts panicking down. But in the meantime, I'm trying to pick up a little bit of money by playing it long. Inventory for tomorrow at 10:30. If oil doesn't recover by then, I'm going to be out of that trade. But for now, again, it's all a matter of proportion to your own, what your own investing style is like. But I don't mind holding a few contracts long to see if it recovers. Just because if I'm lucky, I can catch a dollar and move up and make some good money. Which brokerage firms are you guys using on currently in trade? Well, I like Thinkorswim much better. That's my favorite. Julia Majorga, and Julia says that too. All right, so what is this? Oh, this is our short-term portfolio. Currently up 32%, which is really weird because the short, we take plays like DXD is down, all right, but not much, frankly. So we have a heavy play on DXD. That's a long-term protected play on the market using the Dow. We've got our SQQQ play here. That's down like it's only down a couple $1,000. Frankly, I thought it would be down more. These are our hedges. So we have the SQQQ and the DXD. And then we just have other trades. They're just trades we like for the most part. XRT is kind of a bearish market play. That's flat right now. Tesla, how's Tesla doing? What is this? I'm so confused. Shoot. This can't be right. I'm sorry. This is where it was last week. I'm looking at this thing, well, that cannot be right, because we changed a couple of those things. Apparently the thing doesn't refresh the screen unless you actively do it. All right, more to the point then. Now let's see what our short-term portfolio do. Yeah, look at that Tesla trade. So no, that's not what our Tesla trade looks like anymore. Whoa! Oh, we're doing something wrong. What are we doing wrong, folks? We should not be up 8%. Well, this guy's up $5,000. That's a big difference. This Tesla trade was killing us, and we changed it last week. We got a lot more bearish, and we lucked out. But how far down is Tesla now? Oh yeah, they fell down to 255. They were like 270 last week. That helped a bit, but wow, we should not be up this much. That's not good. Wait, it's not good because it's a bearish portfolio. There you go. That's more like it. DXD is down $5,000, so that makes sense. SQQ is down net about $2,500. All right, so those are our hedges. Those are our big hedges. Other ones are just basically bets, and we're rocking it on the bets. So, wow, that's pretty impressive. 40%. See, I haven't seen one to cash it out, though. I don't like that. Shouldn't be up 40%. We're supposed to be down in an up market. We're supposed to be more bearish than this. Shoot, sorry. We went through this Friday, though. I couldn't find anything I wanted to get rid of. So I felt that way Friday. We were only at 30% on Friday. This is going a little crazy. Mostly for the Tesla, though. That's a big change. Being up $5,000 or more, more than $5,000 on Tesla is huge. This is a hedge, so we're happy with that. GMCR, we still believe that they are going to fall, so we're happy with that. These are just offsets. They're short puts that we sold to offset longer positions. Nothing wrong with any of these. They're all fine. Cake, we love Cake, no problem. SQQ is a hedge. We expect to lose that money. Yahoo is, obviously, we think the Alibaba deal is going to go, and it's actually on track for us. Win, we're bearish on Win, and Win is $200. We're on track. XRT, we're actually even up on that one. That's crazy. So we're up on XRT. We don't think that stuff is going to be a problem. ARO just had more good news. Oh, that's probably doing well too. So that's up a couple of $1,000. Baidu, what's the logic on Baidu? Oh yeah, I remember. With Baidu, we think that they're going to be down, but not too much, and they are down, but not too much so far. We're towards September. We think that the Alibaba IPO is there for Baidu, so our overall is short, but not very short. FAS is the normal stuff with FAS. We sold half of the cover there. SCTY just got they just got a downgrade, and they're on track. And our logic there is the same. We have sold the September 7750 calls. They're nowhere close, no problem. Silver Wheaton, we love silver long term, not a problem. And Tesla, we think it's going to go down. You know what? There's really no point in this put anymore. I don't know why we have that. So we should probably get rid of that. It's not really protecting anything. It's only $1,600, so it's not like it's really hedging anything. It's just an extra debt. And since we're generally just bearish on Tesla, it's less comp. It's like we're bearish, but we're not 140 bearish. We're bearish at 275. We're not saying they're not worth 140. So if something in between, we make money on both, which is nice. But we already made, 13, 14 bucks out of 22. So we're kind of in greed territory here. We do have a whole 2 years to be wrong. So I think on the whole we should probably show that. Wow. I mean, that's terrible, though. I mean, look at this. We're up 40%, and I can only find one thing I want to take off. You know, look, I come from the school where it's like when you're up 40% and it's been less than a year, get out. That's just a lot of money. And, you know, you're not supposed to be up 40% in less than a year. It means you had a really good streak. It doesn't mean you're a genius and you're going to do it all the time. All right, anyway, so that's crazy. And now we'll go to the long-term portfolio. And I know they're doing well because that's 100% bullish. Look at that, almost 22% there. This is, of course, a much bigger portfolio. Our long-term portfolio has started with 500,000, is now up to 608, almost 609. And again, it goes back to now. I'm not really going to review this. We just reviewed it on Friday in member chat, or Thursday. Sorry, it was Thursday. And the review was like nothing changed. I mean, there's nothing changed. Everything's fine. All good, great long-term positions. Exactly the kind. Getting back to all these positions come from not necessarily this buy list, but generally they come from a buy list. This is all they are. These kind of positions are what the long-term portfolio is full of. And it's doing exactly what it's supposed to do. It's making 20% for the year. That's all it's supposed to do. The trick is to do it consistently. And it doesn't seem exciting. Here, watch. Let me write this down. Oh, I see. I'm going to write down category 100, 120. And then I'm going to write 144. And now I need to calculate. There it is. So 144 times 1.2. All right, so that's 172.8. And then times 1.2, 207.36. 207.36. There you go. So, at 20% a year in this is your first year, so 1, 2, 3, 4 years for more than doubling your money. And after that, though, it starts going into crazy numbers. Because think about it, in this next year, in year 5, you're making 40% of double what you started with. You're adding 80%. Oh wait, not sorry, making 20%. So you're adding 40%. You're adding 40% of your original investment in 1 year, just by making the next 20%. And it gets bigger. You know, we'll do a couple more. I'm not going to keep writing it, but 1.2 times. Oh shoot, what was that number? 207.46 times 1.2 times, look at that, 1.2 times 1.2 times. So here we are now, and that was year 5, 6, 7. All right, so already in the 8th year, you're practically adding your original balance each year. All right, so in other words, you know, this is what we're trying to say. It's like, let's stop trying to win the big wins. All right, because if we just follow this simple system and just, you know, protect ourselves and set ourselves up to make 20% a year on a consistent basis, we're going to make 10 years from now. If you start with 100,000 now, and it goes well, in 10 years you'll be making $100,000 per year. Per year. And in 20 years from now, you'll be making 300,000 a year, whatever the hell, it starts getting even bigger and bigger. It seems like crazy numbers, but it's not, because all you're doing is just being consistent and getting a good return on your money. And as you can see, like I said, the key to this, though, it's okay if you pause. You know, if one of these years here that we're talking about, you know, in other words, was 100, 120, 144. If in year 3 you have a bad year and you have 0% increase, you still have your 120. All right. In year 4, or in year 5, or whatever it is, if you start with 144% and you make 0 that year, it's okay. You still have 144% because you protected it. And that means the next year, if you have a good year, and often you will have a very good year after a bad year, right? There's more opportunity. So the trick when the market goes down is just don't lose money. There'll be tons of opportunity to buy. And that's how you do it. All right, and here we've been doing, in fact, every single trade in the long-term portfolio, in the short-term portfolio, we've done in these seminars, every single one. That's what they were started for at the beginning of the year. We started them to track for the new seminars that we started doing. So, you know, all we do is like once a week on Tuesdays generally. I send out a few alerts in between, but generally once a week on Tuesday we make a trade. We have a portfolio that hedges. We have a portfolio that's gung-ho bullish. But gung-ho bullish in the way that, who was it? Was it Craig? I forget who it was. Who was asking, like, why do you want to do that, right? Who asked that question? Yeah, Craig. Okay, so gung-ho bullish in a way that Craig says, oh, why do you want to do that? You're hedging. You know, why are you so nervous? Because I can afford to be nervous. It doesn't cost me anything to be nervous. It's part of my overall strategy to be nervous. And I can't teach it to you. This is the problem with some of these things. I can't really, per se, teach it to you until we have a bad year. When the market goes crash, then we'll say, oh, look, we still have our money. Like, I mean, we sort of saw that a couple of weeks ago when the market took a little dip. Didn't hurt us at all. Our net price of the two portfolios, the net gain on those two portfolios stayed the same. One went down, one went up. All right, so they stayed balanced, and we kept our money, even though the market was crashing. Now, what does that mean? If we keep the money when the market is crashing, let's say the short-term portfolio doubles and goes up $100,000, and the long-term portfolio stays flat at the $600,000 it's at. So then we still have $800,000 in the end. Oh, I'm sorry. So the long-term portfolio now sticks. God, what is it? Somebody tell me. There it is. All right. So the long-term portfolio is 6, and the short-term portfolio is now 140. So let's say the long-term portfolio drops to 560, and the short-term portfolio goes up to 200. They're still going to be about the same as a pair, but the difference will be that the stuff we want to buy, if we start liquidating, doesn't matter which things we liquidate, if we start raising some cash, the things we want to buy are cheaper because we protected ourselves in the downturn. And then we've got opportunities all over the place. All right, that's why we're so cashy here. Okay, we have a $600,000 portfolio with $600,000 in cash. All right, we're using in margin, we're using $300,000 in margin, but don't forget there's like $1 million in margin, ordinary, not even talking portfolio margin. In ordinary margin, we've got $1 million in margin. So we're only using 1/3 of our buying power and none of our cash. So we're dying for an opportunity. We want things to get cheaper. You know, we're looking for stuff to add. We're excited about that concept. Well, we added Whole Foods on 7:30. We added GTAT on GT Advanced on 7:15. So it's not like we're not adding stuff. We had 7:16, 7:1, 8:1, 8:8. You know, it's not that we're not adding things. We're just mellow about it. And we can afford to be because we're following a strategy that's a fairly mellow strategy. It's a great way to make a lot of money over time. All right, so let's see. Now, Bourbon says, just to confirm, which strike do we buy and which do we sell on TQQ? It's a bear put spread, so we want to own the $86 puts. Where is that, in the short-term portfolio? Okay, see, 39.5 now. That's how fast it loses money. It's a very aggressive portfolio. Oh, only $25,000 portfolio. Okay. Ooh, they took a hit. Boy, that killed us. We lost, this QQQ trade cut us $1,000. That was not cool. So we switched to TQQQ. We haven't done anything about this yet. Nah, geez, really? You know, at 7 cents, I think I'm going to have to give it another day. I know it expires on Friday, but 7 cents isn't worth cashing. But the chance that we can do better is more than the money we get from it, the $70 that we can cash. It's, you know, so for $70, it's like a lottery ticket right now. We have a nice sell-off. That sucks. Anyway, so what we did is we now took a TQQQ trade, which is also losing money now. And we bought the $86 puts that were $4.20 the other day. What's today? The 18th? Yesterday. So we bought these for $4.20, and then we sold these guys the $80 puts for $1.90. So what we're betting, TQQ is now 85. We're betting it's going to dip. It went the totally other way, of course. We're betting it's going to dip and end up down below 80. And that would be, it's an ultra short. I'm sorry, TQQ is an ultra long on the NASDAQ. So we're betting the NASDAQ falls and the ultra long falls ultra fast. You know, so far no good on that trade. That's all I can say about it. It's just not working. We've been bearish, you know, we flipped bearish in the 25KT, we're wrong, and it's cost us because we were up almost 20%, so we've lost about 8% of the portfolio, and that's annoying. So it's about $1,500 we've lost in the last couple of weeks because we went bearish and the market did not follow through. You know, in fact, it went the exact opposite way. So that's a bit annoying. Now, Mike says, off topic, would you recommend the new Taser play here or just wait till it settles back down? All right, let's see what Taser's doing. Taser. I always like Taser, but yeah, it's right now it's a little expensive. Oh, I'm sorry, we can look on our long-term portfolio on that buy list. Ah, there it is. All right, so Taser, we had picked in 513. So it wasn't that cheap in 513. We didn't like it so much. It was around $13. Now it's $15.50. I do not like chasing. They're up on news, the news being that people are rioting, and it occurs to police departments around the country. We might see some riots here. And it's obviously, as they notice now, you get trouble when you shoot people, so they think they might want to taser them instead. This is all good for Taser. Also, they've got camera vests. So the cops, they put on a camera as part of the uniform now, and that's a good thing because that's a huge seller. So like a whole nother selling system they have. It all integrates with the same stuff. So almost all the police departments have tasers now, and so the camera's taser cells integrate with the systems they already have, and therefore are easier sells for Taser than for a competitor coming in just trying to sell a camera. Because they've already got the right charging equipment, they already have the same, the rack systems, the clips and all the mount, you know, everything that they need for the systems are there. So it's easier to just add a Taser camera than to go to some third-party camera. That's why. I understand anybody can make a camera. I'm sure, what's his name wants it, GoPro. I'm sure GoPro would let their pop wearing GoPro. But it's, you know, it's tough to get those contracts. They've been working many years. They're the stop. So anyway, can we construct a good Taser play? I'm very comfortable with Taser at 15 long term. So can we construct a Taser play? That's a decent bargain. So let's take a look at where the stocks are, options are, sorry. Go out long term, they're $15.50. Oh, that's a good price. Look, you can sell. All right, here's my logic here. You can sell the $13 puts for $2. That's the last sale price there. To me, that's free money. Taser's at $15.50 now. I absolutely want to own Taser for $13. There's no question. And so since I absolutely want to own Taser for $13, now I don't care about the $2. I want to own them for $13. So A, you can just sell these puts and have a net $11 entry, which is like a 30-something% discount off of where they are now. Or you can sell the 13 puts and say, if Taser ever goes below 13, I'm going to own them long term. And meanwhile, I have $2 to play with. And you can take your $2 and you can buy the $15 calls for, oh, see now, it's hard to tell which is right here. But if I see $4.45 here, if you're telling me to get the $13 calls instead of the $15 calls, all I have to do is pay 65 cents more. I would rather have those for $4.45. I don't see that, though. See the bid-ask spread, though, it's higher. This says $3.80. That's probably about the right price. So I think $3.80, I'd stick with that. So the $15 calls is $3.80. And now I know I have $2 to play with, so what can I sell for $1.80? Well, I can sell the, look at that, the 22s. No, maybe not the 22s, the 20s for sure. So I can take my $2 that I get for selling 13 puts. I can buy the $15 calls for $3.80, and I can sell the $20 calls for $1.85. So it's just about $2. So for free, I now have all of the upside of Taser from $15 to $20. That's how I play it. So in other words, I get 100% of the upside of Taser for the next $5 move, or on my downside, I own Taser for $13. So why would I buy the stock when I can do that instead? All right, the only reason you want to buy the stock is you say, well, I don't think 20 is high enough. That's the only logical reason for buying the stock. Because if I buy the stock and I don't do anything with it, I just wait to see what happens. If Taser goes to 13, I lose $2.50. Well, that's worse, right? But if Taser goes up to 20, I make less money because I'm netting in 15. I'm not netting in at 13 at $15.50. So I make less money all the way up to $20.50. Over $20.50, then it's finally the only time that owning the stock is better than owning the options grid. Only if they're up more than 33% in 16 months. Otherwise, you're better off with the options grid. That's how I like to construct a trade. All right, so in this particular case, even though Taser's kind of gotten away, that's a great spread. So I don't have a price. So that's the way I would definitely play it right now. All right, back to the buy list. I just want to make sure everybody, because you guys are all still Stock Pro members now, well, all the people who belong in the chat room. I don't know if there's any guests. So I want you guys to be, you've got to use this buy list. It's meant to be used constantly. It's meant to be any time you feel like buying something, look at this list and see what there is. Even if you have an idea to buy something in particular, look at this list and compare it to what else you could be buying. What was the spread that was paid to white for slabbing? That's funny, but you tell us you just stopped your whole thing. No, it was the short 2016-13 put for $2, and then buying the $15-20 spread for $2. So you're netting about zero, and Taser's at $15.50, so you have all the upside from 15 to 20. So what else do you want? Oh, I'm sorry. One last point on that. Let's take a look at the net. So if you sell these, so you sell those for $2, look at that, your buying power effect, even if you just do that without anything else, your net buying power is only $1.20, or, well, you know, if you do 10 is 2,000, but your net buying power is $1,200 to collect the 2,000. That is super efficient. That is a wonderful play, because you get hardly any kind of ding at all on your margin. All right, and what's your upside on 10 positions? Your upside is $5,000 if it goes well. That's nice. All right, this is why we are only using 1/3 of our buying power, but still making 20%. Is that portfolio margin? Yeah, that is portfolio margin, that one. Now, Terex, right. I'm sorry, we just talked about Taser and how we love them. Terex, like them too. Now, 520, Terex actually just about back to where it was. So 520, we liked when we did this. We thought we were being smart because they could go on 38, but then they had another big earnings report, and they're down here. It wasn't that bad, though. We actually talked about it at the time, and we didn't feel like adding more, but we felt that was a real overkill to get it down to 34. So they were 39.80, now they're 37.50. And our trade on them, they don't pay a dividend, and we sell the 35 put, so we caught a floor right here for 530, and we left it at that, or we said we can leave it at that. Oh, I see, because we had a big pop. Whenever I wrote this, I wrote this on 6-7, so at the time, it was a well-timed quick winner, then suddenly changed. So, yep, this is another reason why when you make good money fast, take it off the table. That made much more money than we thought it would make very quickly. So, we went from here to here in June. And had we taken it off the table here, we could have got another ride from the same spot, taken it off the table again when we had trouble again, get back in here, another ride, then we would have gotten faked out, but we were still in much better shape than we are now. But all we did here was say we sold these, we have the 30-40 put also. This whole trade is still fine. And again, that goes back to, because of the way we're doing this, what do? We take a 30-40 bull call spread for 550, not very similar to Taser. Bull call spread for 550. We sold the puts for 530, so we only paid net 20 for a $30 entry on the stock. The stock's at 37 now. This isn't a bad trade at all. You can still do this trade for at least this price. I think you can probably get a better price on the set than this one. So that's still very playable. UBN2, that was a great idea by Wombat a while ago. And they have been fantastic, man. I mean, we had been playing earlier. We officially added it here in 528, which is right about here, and they just went crazy. But again, it's like 34 to 45. When it goes up 33% a month, it's time to take it off the table. All right, then you can get back in when we get to the downswing. But in this case, we went with the 2016 45, 55 bull call spread. We went very aggressive on these, and we actually put those in the income portfolio. So, and I said if the stock goes lower, which it never did, and we still like them, we might sell the puts. We never got a chance to sell the puts, unfortunately. It just kept going on. Wendy's. Okay, we like Wendy's. All these restaurants, if you look at the EBA, it's commodities. It's a commodity basket. And we played that at the beginning. We like it again, actually. At this price now, we're starting to like it again. But DBA is a ETF for the commodity. So this is a lot of food stuff, and cotton too, and things like that. But it's all food. It's all coffee, sugar, corn, wheat flour, all that stuff. So back here, as it's coming down, all these restaurants that were having bad reports and had trouble are now getting much, much cheaper prices. You're talking about 10% off their food costs. All right, it's a little more complicated than that because they had a thinning of the cattle herd and all this stuff, and there's certain chicken problems and whatever. There's a lot of things that go into it besides just the crop numbers. But the reality is when food gets cheaper, it's good for people like Wendy's. It's good for people like Whole Foods and things like that. So their food costs go down. They don't drop their prices to compare, and they pick up their margin a little bit. Teeny tiny margin improvements in restaurants like that are huge. So I like Wendy's. I think this little spike in food that was hurting them is coming off the table. All right. So Wendy's still a good one. Still can be done with these prices. Whole Foods, same thing. Okay, they've had margin pressure. They got a ton of competition, but early in the competitive cycle, you have all these other competitors, like about 3 or 4 different competitors to Whole Foods, like Wild Oats or whatever they call them, and another one. When they come in, they go public, they get a bunch of money, and they open up stores. That doesn't mean they're going to succeed. It just means that somebody gave them a bunch of money to open up some stores. Now, in reality, they don't compare well to Whole Foods. And what happens is, and also the supermarkets also went nuts. A lot of supermarkets put in organic type of sections. And so a lot of people have been trying to compete with Whole Foods. Whole Foods is not getting filled. Their margins are under a bit of pressure. But that pressure doesn't last because all the people who invested money in all these other chains because they want to be like Whole Foods are now losing to Whole Foods, and money is pouring down the sink for them. And they start pulling it back or getting out of that business or changing their model. It's all good for Whole Foods and money starts pouring back their way. Also, what's hurt Whole Foods is as commodity prices drop and grain prices got lower, one thing that does hurt Whole Foods is they don't source internationally. They're buying local. They buy very, very big on buying local produce. So when prices went up and spiked, it's very much in their favor because they're dealing with local farmers, and local farmers aren't subject to these national pricing. They say, I'll give you this much, these many apples for this much money. And they don't care what the price of apples is in Washington. They care what the price of apples is in, say, in Missouri or wherever they are. So they don't get affected by those kind of swings up. But on the other hand, when other people start being able to sell apples cheaper, it does hurt Whole Foods a little bit, put pressure on. So a little bit of margin pressure, but nothing wrong with their business model at all. And so long term, I like them. Short term, a little rocky, but a good one. We like them. Let's see. Would you rate some DBA now that it's dropped? Yes, I do like DBA for the long term. I think that you can't get away from the overall. Well, there's two things there. You've got more people in the world, so you need more food. You have droughts that are all over the place with the global warming. And you've got people switching to beef. A lot of people in China are switching to beef consumption and other parts of the developing world. And beef consumption just sucks up a lot more resources than grain consumption does in the eating rice diet. So very, very much long-term trend, more demand for agricultural products. Now, on the other hand, we're getting better at making them. The prices aren't going to be out of control, but the pressure is always going to be, I think the population pressure is always going to be ahead of the manufacturing pressure down, like the efficiency pressure down. And so I think that you're always going to be able to get lucky and catch an upswing in DBA on the shortage. So the trick is just get into the position, recognize when you're profitable, like we did with DBA, we cashed those out. When DBA popped to $30, to $29, we got the hell out. Because we came in at 24. I was banging the table on these guys at 24. But our plan was to get to maybe 30 in 2016. When they go to 30 in July or in April, we got the hell out. That's our 2-year target. And again, this goes back to that Levi thing. So we're talking about the jeans again. It's the same thing. Your Levi's are worth $40 on sale. They retail for $50 and you can buy them for $40 anytime. So when you see them for $30 or even $35, you're excited and you might want to buy them. But you know what? What do you do when it goes to $60? All right, at $60, if some schmuck offers you $60 for your jeans, I'll sell them, man. I know they ain't worth $60. I know that within 2 weeks of the sale, I can buy them again for $40. Same thing. You got to know the value of your stocks. You got to know not just when they're cheap, but you also have to know when they're expensive. And I know a lot of people just fall in love with their stocks and they can't bear to sell them. As soon as they go, whatever it goes up to, if you bought Apple at 75, like we did, it goes to 100, and everybody's like, oh wow, it's going to be 125. It's like, no, it's kind of right at 100. I do think Apple's good for maybe 110 and stuff. 100 is a pretty good price. I'm not like jumping on a bandwagon here at $100. That's a fair price for Apple right now. Depends on the iPhone 6 sales. Depends on a lot of things down the road. 2 years from now, we have bets to 750. I'm sorry, 750. 750 is 125. So our long bets on Apple don't go any higher than 150. But that's down 2 years down the road. At 100 right now, I'm not so excited about that. All right, and we came in at 75. We know what it's worth now, and we know what it's going to be worth in 2 years. In between, it can be up or down, but it's within a certain range. But if Apple goes to 125, I might not want to short it, but I'm sure it's going to sell every long we have. So it's too much. And you got to know what those prices are on your stocks. You have to have an idea of what your stocks are worth. And this is, again, another argument to try to stick to things you know and try to get to learn stocks very well over time. All right? Don't just trade any old thing somebody says. Try to trade things you know and understand. Then you'll know when to get out of things, and you'll know when to get into things. All right, so Nelson Tells is working on a turnaround of when I think they're very turnaround. I think they're fine. Mike says WFM its value to Kroger's on PE looks expensive, but the company has no debt. If they leverage up, they can get growth. I like them because they're moving into Europe also. If Europe stops having trouble, that would be fantastic for them. You know, they've got lots of room to expand. They're not a very big company. Their footprint is fairly small. And as inflation kicks in, which we haven't had any inflation really on food, obviously, but as food inflation kicks in, they don't seem so expensive. That's a very important point. So the more food costs go up, the less the gap between Whole Foods and something else, and the more attractive Whole Foods get. Or says the time to take a loss in SQQQ. We are supposed to take a loss in SQQQ, but the problem is in the 25,000 portfolio, it's down to like 7 cents or something like that. Is it 7 cents? Yeah, it's 7 cents. It isn't worth taking off the table now. It's almost like a lottery ticket now. Off chance that we have a pullback and we get 25 cents for it, let's give it a day and see if we get a pullback. All right, it's basically money down the tube. It's called a dead thing. It was wrong. We quoted wrong. We're not making money out of it. So, all right, that's our hour and a half. And thank you guys. All right, we'll do this thing again next week. Let me see. Is there anything else to clean up on? No, I think we got everything. Anybody have any last-minute questions that take less than a minute to answer? No, okay. All right, guys. Well, thank you very much. All right, have a good weekend, everybody, and well, good weekend early in the week. And we'll speak to you later. All right, thanks.